We're so used to seeing those market charts, the up and down lines, and trying to use all sorts of technical analysis to figure out what's next.
Right, all the patterns and indicators.
Exactly. But what if there's something much deeper going on? What if the very act of us trying to predict the market actually becomes a force that shapes it?
That's the big question, isn't it? And that really takes us into the core ideas of George Soros, especially from his book, The Alchemy of Finance. It's quite influential stuff.
Definitely influential. And we're diving deep into that today.
Absolutely. And look, it's
Hot.
important to realize this isn't just another uh, dry economics book filled with jargon nobody understands.
Right. Not at all.
Soros, I mean, he's a giant in the investment world, but also a really profound thinker. He offers a fundamentally different way of looking at things, not just financial markets, but, well, how our perceptions and actions as humans actually interact with the events around us.
And the source material we're looking at today is great because we get Soros's own words explaining his theory.
Yes, and also some really valuable context about how it landed, its impact over the years.
Okay, so for everyone listening in, our mission today is to really get our heads around Soros's central idea, the theory of reflexivity.
That's the key term.
We want to show you how this constant feedback loop, where what we think influences what happens, and then, well, what happens changes what we think, how that's crucial for understanding why markets move the way they do. But it's not just about economics, is it? I mean, that's what you were saying.
No, not at all. It's really about recognizing the power of human subjectivity, our own thoughts and biases, in shaping the reality we experience whenever thinking people are involved.
It is pretty much everywhere in human affairs.
Precisely. And what makes Soros's work, as we see in our sources, so compelling is that it doesn't just stay, theoretical.
Well, right, it gets practical.
He provides really insightful historical examples, breaks down how these boom-bust cycles actually unfold, and he even shares his own real-time experiment where he actively used this reflexive framework while managing his quantum fund.
Ah, okay, so we get to see the theory in action.
Yeah, in all its messy reality, which is fascinating.
Okay, let's unpack this then. The theory of reflexivity. At its core, like we touched on, it's this idea of a two-way connection between our understanding of the world and the world itself.
Not like physics.
No, exactly. It's not like gravity works the same whether we're watching or not. In markets, our beliefs, our expectations as participants,
Yeah.
our buying, our selling, our strategies, they directly influence prices.
And ultimately, the market's direction.
Yeah.
And then, of course, those very market movements feed back into our thinking. They either reinforce what we thought,
Or they make us completely rethink our assumptions. Uh-oh, maybe I got that wrong.
which it happens a lot. Now, what's fascinating here is how much this clashes with sort of traditional economic thinking. Oh, absolutely. Traditional economics often relies heavily on this concept of equilibrium.
Right, the neat balance point.
Yeah, the idea that supply and demand will just naturally balance out to some stable price. And you have these independent supply and demand curves.
It's tidy on a graph.
It does. But Soros himself argues that these models, while they look neat, often don't really hold up that well in the messy reality of actual markets.
They miss something.
They tend to ignore the way market trends can become self-reinforcing, the way a belief can actually sometimes create the reality it predicts.
Right. And a key part of this, you mentioned it before, is what Soros calls imperfect understanding.
Crucial. We never have all the facts.
Never. Our decisions are always based on incomplete info, plus our own built-in biases. We can't help it.
Exactly. And this is where social sciences like economics or finance really differ from natural sciences like physics or chemistry.
Because in the natural world, things happen regardless of whether we're watching or measuring them.
But in markets, our interpretations, even our misinterpretations, become part of the system itself. They affect outcomes.
Soros even uses this really striking analogy, doesn't he? Suggesting social science sometimes acts more like alchemy?
Yeah, like alchemy, trying to transform perceptions rather than the purely objective analysis you aim for in natural science. It's a powerful image.
It really is. So, to make this clearer, how reflexivity works, Soros identifies two functions.
That's right. Two key functions are at play: the cognitive function and the participating function.
Okay.
The cognitive function is basically our attempt to understand what's going on, to form a picture of reality.
Makes sense.
The participating function is what we do based on that understanding, our buying, selling, investing, voting, whatever it is.
Got it. Understanding and acting.
Now, in what Soros calls humdrum events, sort of everyday stable situations, it's mostly just the participating function that's really active. Our routine actions don't significantly change our basic understanding or the situation itself.
Okay, so like driving to work, my understanding is I need to get to the office that's cognitive, so I participate by driving my car.
Right.
But the act of me driving usually doesn't fundamentally change my need to get to work or, the overall traffic patterns in a huge way day to day.
Exactly. That's a good analogy.
Yeah.
But then you have these other situations, what Soros terms unique historic developments.
Big shifts.
The turning points, the major changes. This is where both the cognitive and the participating functions are firing on all cylinders simultaneously. Our changing views lead us to take significant actions.
And those actions, in turn, fundamentally reshape the situation we're observing and thinking about.
Precisely. And this is where you see the potential for really dramatic, often unexpected outcomes. The feedback loop goes into overdrive.
Okay, this is where it gets really interesting. How this reflexivity pops up in those boom-bust cycles we see in markets all the time.
Well, yeah. Soros describes this typical self-reinforcing process in a boom. It often starts with an initial trend, maybe sparked by some genuine good news or a promising new technology,
Something real kicks it off.
usually. Then, early success as prices start rising make that initial positive belief even stronger. People see prices going up, so they think, aha, see, I was right. This is a great investment.
And they pile in more money.
Exactly. And as more people jump in, this further strengthens that initial belief, that bias. It gets harder and harder to shake, even if there are warning signs.
People ignore the negatives.
Right. Corrections, those sort of natural small dips you might expect, they become less frequent, shallower. There's this growing feeling of invincibility almost.
But ironically,
Ironically, the risk of a big reversal, a crash, actually goes up. Because the higher prices climb, the more stretched the valuations become, the more leveraged people might be, and the more vulnerable the whole thing is to any kind of negative surprise.
Soros uses a really clear example involving stock prices and earnings per share. How much profit a company makes per share.
We tend to think the earnings, the profits, that's the solid, fundamental reality,
Mm.
and the stock price just kind of reflects that.
That's the standard view. Fundamentals drive price.
But Soros points out that the earnings curve itself isn't totally separate. It's also influenced by stock prices. How does that work?
Well, think about it. If a company's stock price is really high, its valuation is high. That can make it much easier for them to raise money, maybe by issuing new stock.
Okay, yeah.
And they can use that money to invest in growth, acquire other companies, pay down debt, all things that can eventually increase their actual earnings.
So the high price helps create better fundamentals down the line.
It can. So it's not just a simple one-way street. Earnings cause price. Price can also influence earnings. It's complex.
So this reflexive connection between prices and belief, it can exist even without big fundamental changes happening, like just sentiment shifts.
Yeah, absolutely. You see that in short-term market noise, the daily ups and downs.
Yeah.
Sentiment shifts. Prices move. Sentiment shifts again.
But it becomes really significant when it becomes really powerful when the fundamentals themselves are also being affected by the prevailing belief, by that bias. That's when you get those really strong self-reinforcing loops, or, on the flip side, self-defeating processes that drive the major boom-bust cycles.
Okay, so just to be clear, reflexivity isn't saying that fundamental analysis looking at a company's actual health, its earnings, its balance sheet is useless.
No, not at all. It's not saying that data doesn't matter.
Instead, it's adding this crucial dynamic layer. It shows us how prices can actually influence those underlying values. It creates this feedback loop that traditional static analysis often misses.
That's a great way to put it. Fundamental analysis gives you maybe a snapshot of value at a point in time. Reflexivity shows you how the picture itself can change based on what the observers, the participants, are doing.
And for an investor, understanding this dynamic, that could be a real edge, right?
Potentially, yes. Helping them spot significant trends or turning points that others might miss if they're only looking at the static numbers.
Now, Soros doesn't just lay out this theory abstractly. He backs it up with some really interesting historical examples. Let's start with one he talks about, the conglomerate boom of the 1960s and 70s. How did reflexivity play out there?
Right, the conglomerate craze. What's fascinating here is how it started. You had these companies, maybe in exciting new fields like technology or defense, that genuinely had high growth rates.
Okay.
And investors rewarded them with really high stock market multiples. They paid a lot for each dollar of earnings because they expected that growth to continue.
Right, the PE ratio was up.
Exactly. But these companies, they started to realize, hey, maybe our super fast growth won't last forever. So they began using their highly valued stock to buy other companies,
Which companies?
often more established, but typically slower growth, maybe more mundane businesses, things in basic manufacturing or consumer goods.
Okay, so the glamorous, high-flying stock buys the steady, maybe boring earner. Makes sense for diversification, perhaps.
It does on the surface. But here's the reflexive twist. When they made these acquisitions using their inflated stock, it often led to an increase in the acquiring company's per-share earnings
Oh.
because they were essentially buying earnings relatively cheaply with their expensive stock.
Yeah.
The accounting math worked out to boost their own earnings per share figure.
Ah, okay. Like financial engineering, almost.
Kind of. And here's the kicker.
Mm.
Instead of their stock multiple going down as they became more diversified and maybe less high growth, it often went up even further
Why?
because the market saw the rising earnings per share and thought, wow, look at that growth. Their success, driven by these acquisitions, then attracted a whole wave of imitators.
So everyone wanted to be a conglomerate.
Pretty soon, even companies with very ordinary businesses could achieve these high multiples just by going on their own acquisition sprees. The perception of growth, fueled by the deals, became self-sustaining. For a while.
It's like the story became more important than the reality.
Exactly. The perception of being a growth company, validated by rising EPS from acquisitions, drove the stock price, which enabled more acquisitions.
Until it couldn't anymore.
Right. Eventually, the music stops. Maybe they run out of good companies to buy that actually boost earnings, or the performance of the companies they bought doesn't live up to the hype, or the market just gets skeptical. Then the whole thing unravels.
Fascinating. Another really interesting example Soros discusses is the REIT boom real estate investment trusts. This one seemed to unfold in, like, distinct stages.
Yes, he breaks it down nicely. The first stage, sort of Act 1, involved investors recognizing the potential of mortgage trusts. These are REITs that invest in mortgages.
Okay.
This growing interest led to more credit becoming easily available to them. That fueled the creation of lots of new REITs and the rapid growth of existing ones. It was a self-reinforcing process. Investor interest, more capital, more REITs, more interest.
Got it. Stage 1, enthusiasm and easy money. What's stage 2?
Stage 2 saw a couple of things happening. Inflation was actually slowing down a bit, which meant the effective yields, the real returns on construction loans were coming down.
Okay, so lending wasn't quite as profitable on its own.
Right. But at the same time, there was a big housing boom going on, and bank credit was still readily available at good rates. So what did the REITs do?
They borrowed more. Leverage.
Exactly. They used higher leverage, borrowed more money to kind of prop up their rates of return, even with those lower underlying yields. And because the market was hot and investors were still enthusiastic, their stock prices often traded at a premium to their book value.
Meaning the market valued them higher than their actual assets were worth on paper?
Precisely. And this premium became a powerful incentive for the REITs to expand even further, issue more stock, make more loans. It led to a rapid increase in their size and their reported per-share earnings. And because it was relatively easy to start a REIT back then,
The number of them exploded.
just ballooned.
Yeah.
Competition increased dramatically.
Which leads us, I presume, to stage 3.
The bust. Inevitably. The self-reinforcing process continues until REITs have basically saturated the construction loan market. All this increased competition forces them to take on greater risks to maintain returns.
Lower quality loans, more speculative projects.
Yep. Construction activity itself becomes more speculative. Bad loans start piling up quietly. Then, eventually, the housing boom cools off. You get an oversupply of housing, the real estate market softens, maybe prices dip.
And suddenly,
Many REITs find themselves holding a lot of loans where the borrowers aren't paying. The banks, who lent the REITs all that money, they get nervous and start demanding repayment.
pulling their credit lines.
Exactly. And that triggers a sharp downturn in the REIT sector. The initial positive feedback loop flips violently into a negative one. Forced selling, collapsing prices. The whole cycle reverses.
Wow. And we've seen similar patterns more recently, haven't we? Like the dot-com boom and bust or aspects of the 2008 crisis?
Absolutely. Think about the venture capital boom and bust in the tech sector around the turn of the millennium. It's that same reflexive dance. Soaring stock prices, an incredibly optimistic bias, and the underlying fundamentals trying to catch up or eventually falling short,
High valuations make it easy for tech startups to get funding.
which fuels rapid growth and innovation, which seems to justify the valuations, attracting more funding for a while.
Until the market cools, the funding dries up, competition gets fierce.
And the actual business results just can't support those stratospheric prices anymore. Same basic reflexive pattern.
Soros also mentions merger mania in the 1980s. How is that different?
Another self-reinforcing cycle, but with some differences from the 60s conglomerates. This time, instead of inflated stock being the main currency for deals, it was often driven more by cash and debt. The scale of the transactions was much bigger too. Think leverage buyouts, hostile takeovers.
And driven by more than just company performance.
Yeah, it was fueled by a whole mix of factors. Changes in the broader economy, shifts in political attitudes towards regulation, tax policy changes, even fluctuations in exchange rates played a role. It was a bigger, more complex reflexive system.
Okay, let's shift gears a bit and look at currency markets. This seems particularly relevant given Soros's own famous trades in this area.
Definitely. In currency markets, maybe more than anywhere else, expectations about future exchange rates are just paramount.
That's the main game.
It really is, especially for investors looking at the total return, which includes both interest rate differences and currency movements. It's very similar to how expectations about future stock prices drive the stock market.
Soros talks about a benign circle for Germany in the late 70s.
Yes, the German mark, the Deutschmark back then, was appreciating in value. And crucially, this appreciation was greater than the difference in interest rates you could get in Germany compared to, say, the US.
So even if German interest rates were lower,
The rising value of the mark more than made up for it. It became very profitable just to hold marks. This attracted a self-reinforcing flow of speculative money into the mark, which of course pushed its value even higher.
a positive feedback loop for the mark. And on the flip side, the US experienced a vicious circle around the same time.
Precisely. As the US dollar was depreciating, falling in value, the rate of inflation in the US started accelerating.
Okay.
Now, even though nominal interest rates, the stated rates were going up in the US, inflation was rising faster. So real interest rates, nominal rates minus inflation remain low, sometimes even negative.
Meaning holding dollars was losing you purchasing power.
Right. And attempts by the U.S. government to stop the outflow of money from the dollar, like issuing these special Carter bonds denominated in foreign currencies, they didn't really work effectively.
Until
Until the Federal Reserve, under Paul Volcker, adopted a much tighter monetary policy, dramatically hiking interest rates. That finally broke the vicious circle.
then came the Reagan era, and what Soros calls Reagan's imperial circle. That sounds different again.
It was a different dynamic, yes. This wasn't driven by a weak dollar, but a very strong one. It was sustained primarily by a significant gap between high U.S. interest rates and lower rates elsewhere.
Attracting money into the US.
Exactly. Huge amounts of capital flowed into the U.S. seeking those higher returns. This strong dollar, however, made U.S. goods expensive overseas and foreign goods cheap in the U.S., leading to a ballooning trade deficit.
But the capital flowing in financed that deficit.
Yes, for a time. The continuous inflow of foreign capital essentially paid for the excess of imports over exports. But Soros points out that this circle was inherently unstable
Why?
because the whole thing depended on that continuous inflow of capital, which was attracted by the strong dollar and high rates. But the strong dollar itself depended on the capital inflow. And all that foreign borrowing meant ever-increasing interest payments and debt repayments flowing out of the U.S. It couldn't go on forever. Something had to give.
And despite this clear imbalance, Soros notes that traders who tried to bet against the strong dollar during that period often got burned.
Yeah, for quite a while. Speculation, in this case, didn't act as a stabilizing force, correcting the imbalance. Instead, the trend-following behavior of speculators actually strengthened the trend, pushing the dollar higher than fundamentals might have justified, and arguably making the eventual correction even larger.
So this reinforces his idea about currencies moving in big waves.
That's a key insight. Soros argues that currencies often move in these large multi-year waves precisely because of these self-validating trends driven by speculative capital flows.
Trend followers dominate.
Often, yes. The profits they make by riding the trend attract even more capital, which reinforces the trend, which makes the underlying imbalance, like the U.S. trade deficit back then, even greater.
So he challenges the idea that just letting exchange rates float freely automatically leads to stability.
He does. He suggests it can actually lead to cumulative instability because these reflexive feedback loops can take hold and drive currencies far away from any kind of fundamental equilibrium for long periods.
Okay, let's move on to another area where Soros sees reflexivity clearly at work. The credit and regulatory cycle.
Right. Here, the reflexive process involves the interplay between the real economy, producing goods and services, and the financial economy, lending, borrowing, asset prices.
How does that loop work?
Well, typically, a strong economy boosts asset values like houses, stocks, and increases incomes. This makes people and businesses seem more creditworthy. Lenders feel more confident.
So they lend more.
Exactly. Now, in the early stages of a credit expansion, the total amount of borrowing might still be relatively small compared to the overall economy. So its impact on the value of the assets being used as collateral isn't huge.
It starts slowly. Lending seems safe.
Right. But as more and more debt piles up, the total volume of lending becomes significant, and it starts to have a noticeable positive effect on the value of those assets being used as collateral.
Like rising house prices fueled by easier mortgages.
That's a classic example.
Yeah.
The lending itself pushes up the asset values, which makes people feel wealthier, encourages more borrowing, justifies more lending. It's a positive feedback loop. The rising tide lifts all boats, or seems to.
No,
Until you reach a point where the total amount of new credit can no longer grow fast enough to keep stimulating the economy and pushing asset prices higher. By this time, those asset values have become heavily dependent on the continued flow of new lending.
They're inflated.
They can be, yeah. So when that lending inevitably slows down, maybe because lenders get worried or interest rates rise or regulators tighten standards, asset values start to wobble, maybe decline.
And that feeds back negatively.
Exactly. Falling asset values hurt economic activity, make borrowers less creditworthy, make lenders even more cautious. It becomes a negative feedback loop.
And because people might be heavily borrowed against those assets by then.
A decline can trigger margin calls, forced selling of assets to repay loans, which pushes prices down further, making the downturn much sharper. It can snowball downwards.
And Soros points out that this specific reflexive link between the volume of lending and the value of the collateral itself isn't always well recognized in traditional theories of economic cycles.
That's a really crucial observation he makes. He thinks it's often overlooked. He also introduces the idea of a regulatory cycle.
How does that fit in?
Well, regulations often get tightened after a crisis, when the damage is done. Then, during the next boom, there might be a push for deregulation as memories fade and the focus shifts to growth. So regulation isn't static. It tends to move in waves, often lagging behind the credit cycle.
And the interaction between the two is complex.
Very complex and not always predictable. For instance, central banks often gain more power and stricter rules emerge after each major financial crisis, which means each subsequent cycle plays out under slightly different conditions. History doesn't repeat exactly.
Looking back, Soros frames the entire post-World War II period up to the mid-1980s when he was writing as basically one long expansionary boom.
Yes, a massive credit expansion, punctuated by smaller cycles, but generally upward trending.
And he felt it was getting potentially ripe for a major bust.
He did. But he argues that timely government interventions at key points preventing major defaults, bailing out institutions, and particularly the development of that Reagan's imperial circle we discussed, managed to postpone or avert a really deep systemic collapse, at least for a while.
But those interventions themselves then shape the future path.
Absolutely. They prevent one kind of crisis, but might set the stage for different kinds of imbalances or problems down the road. It's an ongoing dynamic.
Now, this wasn't just theory for Soros. He famously put his money where his mouth was in a real-time experiment back in 1985 and 1986. Tell us about that.
Yeah, this is a really fascinating part of the book. It was a unique undertaking where Soros essentially decided to actively trade his quantum fund based explicitly on his reflexive theories, documenting his thinking as he went.
And this was triggered by the Plaza Accord.
The Plaza Accord in September 1985 was a key catalyst. That was the agreement between the big economies, U.S., Japan, Germany, France, UK, to try and coordinate intervention to weaken the strong U.S. dollar.
And Quantum Fund was, well, not your average fund.
No, definitely not. It was known for using significant leverage borrowed money to amplify bets, and it operated across many different markets globally: currencies, bonds, stocks, commodities. And importantly, Soros managed it with a large chunk of his own money invested.
So he had serious skin in the game. What were his initial thoughts going into this experiment?
He was, I'd say, cautiously optimistic that the authorities could manage the dollar's decline smoothly, but he was also very aware of the risks involved in trying to unwind the excesses of the previous imperial circle period.
What was his main worry?
His primary concern was what would happen to the U.S. economy. He initially leaned towards expecting a credit contraction, maybe even a recession, as the stimulus from the strong dollar and capital inflows faded. He wasn't sure if consumers would keep spending if monetary policy tried to pick up the slack.
And he saw signs supporting this view.
Yeah, he noted that the stock market wasn't performing very well at the outset, which seemed to him to fit with his concerns about the declining value of collateral potentially weighing on the economy.
But the market, as it often does, had other ideas. It didn't just follow his script.
No, it definitely didn't. That's one of those interesting parts. Soros describes being repeatedly surprised by the market's resilience in some areas or by unexpected twists. He was constantly adjusting his positions in the Japanese yen, the German mark, U.S. bonds, global stocks. It was very dynamic.
What were some of the big shifts he observed?
He saw a clear shift in U.S. policy, away from fiscal stimulus, government spending tax cuts, towards relying more on monetary stimulus, lower interest rates. He also noted the significant international cooperation, particularly between the U.S., Japan, and Germany, to try and manage the dollar's fall and avoid a crash.
Did his outlook change dramatically?
It fluctuated. He even flirted with the idea that maybe a new golden age of capitalism was emerging, driven by global cooperation and disinflation. But he remained wary of the underlying imbalances and potential pitfalls.
And then there was that unexpected stock market boom in early '86.
Yes, that made him significantly more bullish for a period, but then came a sharp correction, triggered, seemingly, by plummeting oil prices, which threw another wrench into the works.
So it sounds like a constant process of forming a hypothesis, testing it, seeing the market react, and then revising that hypothesis.
Absolutely. The later part of the experiment, reading his journal entries, is filled with uncertainty. He's grappling with volatile markets, considering scenarios ranging from vicious economic spirals to potential new policy breakthroughs. It was far from a smooth ride.
He also mentions things happening after the experiment officially ended, like the Bafesti insider trading scandal and an OPEC agreement on oil production.
Yes, he saw those events, particularly the OPEC deal stabilizing oil prices, as generally bullish for markets at the time, reinforcing the sense that maybe a crisis had been averted.
So what was the big takeaway from this whole real-time experiment? Did it validate his theory of reflexivity?
Well, here's the fascinating part. Perhaps the most significant conclusion Soros draws is his own admission that his track record in actually predicting specific market events during this period was, in his words, downright dismal.
Dismal, but the fund did well financially, didn't it?
Yes, Quantum Fund performed very well. But Soros makes a crucial distinction. He attributes the financial success more to his ability to recognize and react to unfolding reflexive processes, and to cut losses when his hypotheses prove wrong, rather than to accurate forecasting.
Ah, so it's not about having a perfect crystal ball.
Not at all. He specifically points to the alchemical nature of his approach. Success in the market doesn't necessarily equate to having a scientifically validated predictive theory in the way a physicist might. The experiment really hammered home for him how often his own understanding was flawed or incomplete, and how crucial it was to constantly adapt based on market feedback.
Which brings us right back to that fundamental point about the difference between social and natural sciences.
Exactly. Because you have these thinking, acting participants involved, the whole game is different.
Our thinking affects the outcome.
Right. As Soros emphasizes again, the fact that we're dealing with thinking participants fundamentally changes the nature of what we're studying. Success in social science experiments like Soros making money doesn't provide the same kind of clear-cut validation for a theory as, say, an experiment in chemistry.
Why not?
Because the theory itself, once known, can influence how people behave. It can lead to self-fulfilling prophecies or people trying to game the system based on the theory. The reality being studied isn't independent of the theories about it.
Which is why Soros famously said that social science is a false metaphor.
Precisely. He felt the claim to scientific certainty, often made in economics or sociology, was misleading because it ignored this inherent reflexivity.
Okay, so if perfect prediction is out the window and markets are inherently shaped by these often unstable feedback loops, what does Soros suggest we should do, especially regarding the financial system?
Well, Soros is quite clear in his belief that financial markets are inherently unstable. They are prone to booms and busts because of reflexivity. Therefore, he argues, they require some form of regulation or intervention to prevent excessive instability.
But he doesn't claim to have all the answers?
No, he's actually quite modest on that front. He says he's much better at identifying the flaws in existing systems than designing perfect new ones. He points to major global imbalances as key sources of instability, like, at the time he was writing, Japan producing far more than it consumed, and the U.S. consuming far more than it produced.
And he highlighted specific areas needing reform?
Yes, he identified three main problem areas needing systemic reform. First, the system of exchange rates between currencies. Second, the volatility of commodity prices, especially oil. And third, the persistent problem of international debt, particularly for developing countries.
Any others?
He also flags international capital markets themselves. While often praised for efficiency, he saw them as prone to the same kinds of reflexive excesses as bank lending, citing the boom in international bank loans in the 1970s as an example.
So what were some of his broad ideas for tackling these problems? Let's start with exchange rates.
Okay, on exchange rates, he strongly argued against freely floating rates, believing they were inherently destabilizing due to speculative feedback loops.
That fix them.
Not exactly fixed either. He also wasn't keen on target zones, setting specific bands for currencies, because he thought that just invited speculators to test the boundaries. Instead, he advocated for a managed float system,
Meaning?
meaning governments and central banks would actively intervene in the market to guide currency movements and counteract excessive speculation, but without rigid targets. More flexible, active management.
Okay. What about international debt? That was a huge issue in the 80s.
Massive. He proposed a comprehensive reorganization plan. It wasn't just about debt relief, but a package deal involving how existing debt was treated, providing new credit, ensuring the banking system remained stable, requiring policy adjustments within the debtor countries, and, importantly, finding ways to encourage capital that had fled those countries to return.
Were others thinking along similar lines?
Yes, he explicitly mentions that prominent figures like Senator Bill Bradley and the economist Henry Kaufman were putting forward similar comprehensive ideas around the same time. It was clearly a major concern.
And his idea for oil stabilization sounds quite ambitious.
It was very ambitious. He suggested a scheme centered around a benchmark price for oil. Industrialized nations, the main consumers, would pay a levy or tax on their consumption.
Okay.
And oil-producing nations would receive rebates based on their production, possibly linked to adhering to quotas. The system would also involve managing buffer stocks of oil buying when prices were low, selling it high to try and smooth out those wild price swings.
And he saw a potential link to the debt problem.
He did. He speculated that perhaps the funds generated by the oil levy could somehow be channeled towards alleviating the international debt crisis, killing two birds with one stone. But he acknowledged the immense practical difficulties, especially in getting countries to agree on production and consumption quotas. Very complex politics involved.
He also talks about the paradox of systemic reform, doesn't he?
Yes, which loops back to imperfect understanding. The paradox is, how can we design perfect systems when our own understanding of how these complex social and economic systems work is inherently flawed and incomplete?
A fundamental dilemma.
It is. But Soros argues that this shouldn't paralyze us. We shouldn't give up on trying to create better, even if imperfect and temporary, solutions. He felt that making things incrementally better, reducing instability somewhat, was far preferable to just letting crises unfold unchecked.
Even though he wasn't a fan of bureaucracy.
Right. He expresses an aversion to bureaucracy, but ultimately concludes that some level of thoughtful regulation and international cooperation is necessary to manage the inherent instability of global finance.
Now, in a postscript added later to the book, Soros briefly touches on the 1987 stock market crash. What was his take on that?
He connects the crash, interestingly, partly to stresses originating in the Japanese bond market, highlighting Japan's emergence as a dominant global financial power, the world's banker at that time.
And the U.S. response.
He notes that the U.S. authorities responded to the stock market crash primarily by letting the dollar fall further, essentially prioritizing avoiding a deeper stock market collapse over stabilizing the currency. He draws a somewhat worrying parallel to policy responses in the 1930s during the Great Depression.
So bringing this all together, what are Soros's sort of final thoughts on reflexivity and how we make sense of the world?
He really comes back to his core idea that our values, our understanding of the world, even our perception of reality itself, are deeply shaped by these ongoing reflexive processes. We aren't just discovering objective truths. We're actively participating in creating the reality we experience.
And he has that phrase, fertile fallacy.
Yes, that's a really thought-provoking concept. He suggests that maybe life, or at least our engagement with the world, is a kind of fertile fallacy. Our understanding is always imperfect, flawed. But it's precisely in grappling with these flaws, in constantly trying to make sense of things and revise our conceptions, that progress happens and meaning is found.
So it's about the process, the ongoing learning.
Exactly. It's a never-ending process of learning, adapting, and revising our understanding of the incredibly complex systems, financial, social, political, that we are all a part of.
Okay. So For everyone listening, I think the main takeaway from this deep dive into Soros's work is that this theory of reflexivity offers a really powerful lens. It helps us see how our thoughts and actions as participants don't just passively observe what's happening.
They actively shape it,
Yeah.
especially in dynamic systems like financial markets, but arguably elsewhere too. It really moves us beyond simple linear cause and effect thinking.
And while Soros's own experience suggests that perfectly predicting the future in these kinds of reflexive systems might be, well, basically impossible,
Right. Don't expect a magic formula.
understanding this reflexive nature of things can still give you a significant advantage. It offers deeper insights into why things happened the way they did in the past.
And potentially provides a crucial edge, or at least a better framework, for navigating the uncertainties that lie ahead. Helps you ask better questions.
Definitely. So here's a final thought we want to leave you with, something to maybe mull over. Think about a situation in your own life. It could be at work, in your investments, maybe even in your relationships or your community. Where might this theory of reflexivity be at play?
Hmm.
How might recognizing a potential feedback loop between your own beliefs or collective beliefs and the actual situation change how you see things? Or maybe even change how you decide to act?
It's a fascinating question to ponder. How much are we observing, and how much are we participating in creating the reality around us?
We've really only managed to scratch the surface of George Soros's deep and often challenging ideas today.
Absolutely. There's a lot more in The Alchemy of Finance and his other writings.
So we definitely encourage you, if this sparked your interest, to explore his work further. Delve deeper into these concepts of reflexivity and imperfect understanding.
Yeah, there's a lot there for anyone who really wants to grapple with the complexities of the world we live in. It's challenging but rewarding stuff.